From the most sought after man to most chased after man, Ridham Desai from Morgan Stanley.
He joins us right now. Ridham, good morning. Thank you for joining us. Wish you and your family a wonderful 2017.
Wish you and your viewers as well a great, prosperous, happy, joyous 2017.
But right now you're getting that feeling that the markets would make it all that prosperous for us?
Yeah, see, Ayesha, we have no idea what the future will bring to us. But in stocks, I think you look at the prices, which is i.e. valuations, and then you make a judgment. And I think right now we are sitting at that point where valuations are the most attractive they've been in a while. The metric that I like to use is comparing earnings yield to bond yield. And they are at par. The last time they were at par was in the summer of 2013 after the big sell-off that happened when the Fed threatened to taper. And that wasn't a bad moment to buy stocks. So we're in a similar situation. I think there's clearly a case for asset allocation shift, which is move away from bonds into equities. And equities, I think, should likely do better in 2017. I said that in 16 as well, so it didn't quite work out. So you got to take these advices with a
pinch of salt.
Always.
But the valuations are not the same as they were back in 2013. I mean, stocks are not as cheap.
You see, valuations are never in absolute context. They're always relative to history and relative to other asset classes. So equities are looking quite attractive relative to bonds. I mean, the bond yield is at, say, 6.4, and the equity yield is also at circa 6.4. So that's for a growing economy like India, I think that's very attractive. For another economy where growth is a problem, it is not that attractive. I mean, you can see that in, say, Europe, where the earnings yield will be persistently higher than the bond yield because there's not that much growth in that economy. But India arguably has got a lot more growth left in the next 10, 20, 30 years. Bonds will deliver coupons for 10 years and that's it. Equity coupons will continue beyond that. So I think if the yields are similar, then I would argue that equities are looking more attractive than bonds. So
but is the uncertainty around budget, around earnings, impact of demonetization, etc., a little frustrating right now because it's sort of into a black hole oblivion. You don't know how it's all going to play out.
I'll make a very cliched comment. The point of maximum return equals to the point of maximum uncertainty, right? Or vice versa. So you can't make money in stocks unless there's uncertainty. So if everything becomes certain, then stocks are fully priced. Stocks see in advance. I just published a note this morning, which was about how various styles worked in 2016. And in the month of December, growth stocks actually did very well. Now that's sounding counterintuitive. At the start of the month, you would have argued that growth stocks will do actually poorly because growth environment was uncertain. The market looks through that. The market is a forward-looking animal. I mean, how many times do we repeat the same thing, right? So the market, I think, is looking at growth turning around. And if growth stocks become reasonably priced, I think they'll be bought. And that's exactly where we are right now. Growth stocks look more reasonably priced than they've been for the past 2 or 3 years. So they'll be purchased.
So the headline will change next year, right? 2016 was the year everything worked but nothing made money. 2017, some things will work and a lot of things will make money.
I have no idea.
Just based.
No, I think you manage your risk. You buy stocks where the valuations look attractive, and I think there are a few things that are going in favor of India right now. Global growth seems to have stabilized, which was working against us for the past 2 years. So that should provide some tailwind to growth. I think domestic demand is looking better. I mean, keeping aside the temporary blip from the currency exchange program. I think the worst of that will be behind us soon. So domestic demand will recover. Private capex is still weak. It has been for quite a while. 12 months ago, I thought it will start recovering. And it hasn't, and I'm still saying it will take another 12, 18 months. So it's clearly disappointing us. Government spending is actually quite good. So the government has got its act very nicely done on the fiscal side. So I think there are a few factors favoring the growth environment. And therefore, I think it should be okay in 2017 compared to 16.
Ridham, it's important to understand the market style, like your note emphasizes. 2008, if you bought consumer names from 2008 to 2014-15, you made a lot of money. When markets have been nervous, if you bought into IT and pharma, you protected your capital. So in terms of a style, given that local growth is uncertain, globally things are looking up, what style will work now?
No, I think you want to buy growth. As a style.
Which is both local and global growth.
Yeah, because I think local growth has seen its worst. In fact, the quarter ended September in terms of earnings was the best quarter since 2010 or 2011. So it's the best quarter in 5 years. Had we not had this currency exchange program, the December quarter would have been really good. And earnings revisions may have turned positive for the first time in 6 years. So that has been pushed back by a quarter or so. But I don't think the story has ended. You will see a pretty good bounce back. Underlying demand conditions are pretty good. Jobs are coming back. So there's a temporary lull that has been created, but I think we'll be through that quite quickly.
You know, over the years, what I've learned is that it's important to not judge the news, but judge the impact of the news on prices. So how much of this demonetization impact is already in the price? What is your assessment?
All of it, I think.
Okay.
Yeah, so I think all of it is in the price. India has underperformed emerging markets. It's done quite poorly, and I judge it by the underperformance rather than the absolute price decline, because there's been an absolute price decline everywhere in the emerging world thanks to the rising dollar. India has in turn underperformed. So I would imagine that underperformance is largely because of what happened in November, December. So most of it is in the price.
Okay. The question that I would have is that we underperformed while the US markets went up quite significantly. If indeed at some point of time over the course of the next 6 to 9 odd months, yields move up, rates move up in the US, and I think there was an empirical evidence that Mark Faber gave yesterday or day before that when yields touch a particular number, US markets started sliding quite considerably. What if the global markets start underperforming 6 months, 9 months, particularly the US? The impact that it could have on our markets, because we have hitherto underperformed. Can our period of outperformance coincide with the global sell-off, for the lack of a better word?
So I don't think it's fair to compare India to US stock markets. I think India is an emerging market, so it should be seen in the context of EM.
So what he means is if they're going to slide, we will also
the impact
get
that it had on our
that.
markets.
Yeah, but you see, if you look at the global equity market complex, it's all over the place.
Right.
So you have Japan that's doing well. You have US that's doing well. You have Europe and EM that's not doing well. So I don't think there's a synchronous bull market where all these equity markets are going up. Right. So there will be some that will be going up, some that will be going down. For 2017, our global macro guys believe it's going to be Japan, followed by the US, followed by Europe, or rather followed by Europe, followed by US, followed by emerging markets. So we are actually bearish as a house on EM.
Okay.
So in that context, I think India, will outperform. So India is our biggest overweight position in EM. So India could actually be a much better performer relative to EM compared to this year, the year that's gone by. But I don't think we're in a synchronous bull market. We're more constructive on equities and credit, but it's not a runaway bull market. It's not a very high return world. It's a low return world.
So 10% return?
For India, I'm arguing for double-digit returns, so maybe 15%. We've had 2 years of negative returns, so some of it will come back, but we don't know. I mean, this is all in the context of what happens globally, what happens in India. These are not. I don't hang on to these numbers. They go wrong more often than right.
The minute I look at the strength in US market, and the world believes that the new administration, which is the Trump administration, is shovel ready. They'll come and reboot the American economy. They'll jumpstart the US economy. But the more I analyze the setup of US politics, I'm getting a sense that this is like a Modi rally in 2014. First there was hope and hype and everything went up, and then realization hit us. So the similar kind of a phenomenon could happen to US markets in 2017?
Yeah, my US strategist is less constructive on US stock markets.
Okay.
So he is certainly looking at US underperforming Europe and Japan.
There is this talk that the bond market or the bond market, bull market in bond is over. Money will move back into developed market equities. Yields are also getting better. So the real chase the yields is going to come down. Is that a logic which could hit emerging markets, that nobody wants to take risk because if the T-bill goes through 3%, that's a reasonable return?
Maybe. I mean, it's one of the reasons why we are not constructive on EM, that the dollar continues to rise, that the Fed is going to hike maybe 3 times next year, so this year. So it is a challenging environment for EM.
Let's talk about back home, and how critical, according to you, would be events like the budget as well as the Uttar Pradesh state elections? Do you think they could be big market moving events, or do you think again the negatives and the positives are already in the price?
There will be volatility. I don't reckon that there will be defining moments for the market.
Not even UP elections?
No, I don't think so. But there will be volatility around these things for sure. I mean, there will be a result that if it is unanticipated by the market, I don't know what's actually priced into the market. I guess the market expects or hopes is the right word, I think, hopes that the BJP wins. And if it doesn't, then there will be volatility around it. You could have a couple of days of fall and some excitement on your channel. But I don't think but I don't think it's going to be a defining moment to the underlying trend. And the underlying trend seems to be up rather than down. It has been up rather than down for most of the past 3 years. It's not like the previous bull market, which is it's not gone up in a V shape or in a steep angle. So it's a little of a softer angle. I think that kind of is the story even for the rest of this year.
But how
So what within, sorry.
No, just a follow up to that, and which is that, you know, if 2016 taught us one thing, was that global large events, don't bet on binary events, and Brexit and the other events that happened taught us that. Now, in a manner of speaking, this
taught us something else, but I'll come to that. Yeah.
Okay, so that also.
Yeah.
No, but so
Don't
what I was
go
just
by the polls.
but that's a big thing too. But you know, in a manner of speaking, both the budget as well as the UP elections will be binary events. The budget either has to be a good one or a bad one this time around, more so than ever before. And UP naturally will be a binary event. So I'm sure you kind of make your clients position their portfolios in a way in preparation for these events as well, so to say. You have to, right? Because there could be extreme volatility, extreme bouts of volatility. So how do you approach both of these then?
Yeah, so firstly on what 2016 taught us. So what it taught us is that don't rely on expert opinion on the impact of events. Okay, forecasting the event is a completely different matter. And suppose I did forecast Brexit, right? We were not able to forecast the impact of it. Even if I forecasted a Trump victory, the impact of that.
Did you?
It doesn't matter because, you know, my job is not to forecast the event, it is to forecast the impact, right? And we've struggled. Expert opinion has struggled, including myself, to understand the implications of these, and markets have done something which is different from what we would have expected. So likewise with the UPN budget, right? Yeah. So there's an event and then there's the impact of the event, right? So I think my early opinion here is that the impact of these events is likely to be moderate.
Okay.
There will be volatility, but it will not change the underlying trend. Okay. Now, can the budget produce something that changes the underlying trend? Well, on the positive side, if the finance minister gets courageous and cuts tax rates by a big amount, then it could trigger a big rally in the market, which could sustain beyond the month of February. Usually, the budget impact fades as the month passes by. And or on the other side, if the government chooses to get very populist, it may scare the market off. So I could think about the events and how the market could behave. But, you know, keeping in mind what we learned in 2016, we have to take these things very carefully. But I think the bottom line here is that these events may not be as such very defining events. Okay. Yeah, great. There's a great media show around it. I can see that. Lots of entertainment on television, but stock prices will do this and then they'll...
Yeah, we cater to all the peaks.
So continue to chase growth stocks is what you believe?
You don't chase anything. I think you buy them at a reasonable price. And I think a lot of growth stocks are actually available at quite reasonable levels. They're down 20-30%.
What pockets begin?
Yeah, I'll come to that. Yeah. So they're down 20-30%. If you were willing to buy them 30% higher, I think you should definitely be interested in buying them 20-30% lower. The underlying stories have not really changed. Yes, they have lost a quarter of growth, maybe 5 months of growth, but that's about it. And you're getting more than that in terms of share price. In terms of pockets, I like the non-banking finance space. I like the banks. I think the rate cycle in India is coming to an end.
Privates or PSBs?
Privates, generally speaking. Their business models are better. I'm a little hesitant on housing finance companies because the rate cycle is coming to an end. They are wholesale funders. And if rates are not going to fall any further, their margins will come under pressure. I like tech stocks. I think the US growth story has got some hope. US capex could recover. That's good for tech stocks. And look at what the tech stocks are pricing in. They're pricing in single-digit growth for the next 5 years. So this is quite an attractive place to be in. I like consumer discretionary. As I said, I think underlying demand in India is picking up. Discretionary demand is picking up. I think we're heading for a really strong year for farm income. So keep a watch on companies that rely on farm incomes for their business. I think they should do quite well. In fact, the Rabi sowing is very encouraging, and if we are going to end the season like this could be the best farm year in several years for India. And it's had really not been affected by demonetization, because the credit cycles in rural India are far more robust than in urban India. So the way we sense out here people retracting demand, it's a very urban phenomenon. I don't think that's happening the same way in rural India. And you can see that difference in performance in the autos.
The tractor sales,
tractor sales in December, because I think underlying farm demand is quite strong. So those are the spaces we like. I don't like consumer staples because I think the multiples are still high and the growth is not that good, and commodity prices are going up. So the last 3 years tailwind of low commodity prices is ending, so their margins will be under pressure, or they'll have to cut ad expenses. Either way, I think they'll have a challenging environment, and it's certainly not fully priced in. I would avoid utilities because I think the rate cycle is coming to an end. So some of these utilities did very well because they are proxies on long rates, and the long rate I think has probably done its trough in November. So it's unlikely to go back there in a hurry. Then I think telecom still remains a challenging space given the competitive environment. So generally speaking, you can avoid it. Stocks are looking cheap, but maybe deservedly so. So that's a tricky space to be in, and there's growth elsewhere, so I wouldn't bother about it. Wow. So that's, I think, how industrials, I think if there is a lasting impact of the currency exchange program, I think it's come on industrials because it's actually pushed private capex back by maybe another 6-8 months, and that was anyway struggling. So maybe industrials will take a bit of a backseat.
Now, what we've seen in last 2 years or 2.5 years is that markets have moved up in anticipation of earnings, and earnings have not kicked in. Earning recovery will get delayed by 2, 3, 4. I mean, that's an arguable, point, but earnings recovery will get delayed for at least 2 quarters. Do you think that market returns this time could be back-ended? Once bitten, twice shy. Markets may wait for real earnings recovery and then they'll reward stocks.
But Nikunj, I would argue that the market has given up whatever hope it had for earnings, right? Yeah. The Nifty is circa 8,000, which is about the same level it has been for 2 years now. So what earnings recovery is priced in? It's not priced in. So I think if the signs of an earnings recovery are at our doorstep, the markets will respond.
So 2017 could be one of those years where we'll worry a lot, we'll speculate a lot, we'll talk about demonetization impact, we'll talk about global adjustment in bond prices and equity markets, but the market returns could be positive.
Yeah, you may not even talk about these things, by the way, because they'll fade away into the background. So the stories will change.
It is so true. A year ago, what were we talking? We were talking about disruption in commodity prices. We were talking about how sell-off in commodity prices will kill commodity producing countries like Brazil and Russia, and today we are not discussing that.
Best performing sector in 2016 was materials.
So in that same vein, can I say that for pharma? Can I say that for pharma? Because a bombed out pocket in this market is actually
actually technology.
Well, technology and pharma both.
I prefer tech.
You would prefer tech.
So you're obviously not reading much into Sika's letter to his employees.
No, that's all fine. I'll tell you, the pharma sector has more idiosyncratic factors. So it's less of a macro call. So you'll have to get very stock specific. In technology, I can make a more macro call, top-down call.
I've looked at a report, and a very interesting report from Morgan Stanley, it was authorized with you, which talked about the correlation between US bond yields and the IT stocks. But some would argue that that's old data. The nature of tech companies has changed. If US economy recovers, what is the guarantee that the new tech will recover? Because the new tech is all about customization, SMAC, automation. It's not really connected with the US economic growth.
Yeah, you can argue that, and of course these relationships do not continue forever and they break down. I recall in the late 50s, the earnings yield in the US used to always be above the bond yield.
Yes.
And that had a 100-year track record. So it's
but that time you're coming off from World War.
No, it had a 100-year track record. Okay. The data went back to 1860. People didn't buy stocks if the earnings yield was lower than the bond yield. It changed all of a sudden in the late 50s, and since then, the US has never had the earnings yield below the bond yield, and unless you've had a deep bear market. Okay, so it's always been a buying opportunity. So these things can change. So historical correlations are not reliable, but the logic is that the US yields represent underlying US growth, and if business capex in the US is recovering, then to some extent it will translate into greater orders for Indian companies. The strength of the correlation may have weakened. I can't be very precise about it. But given the prices in India where the tech stocks are trading, I think there's a lot of comfort that I have with respect to this call.
So you're obviously completely ignoring Sikka's message to his employees saying, wake up. I mean, the world is moving towards a different style of technology. There's lots to catch up on,
Ayesha, no, we don't ignore anybody's message. The time frame of these messages is important. So is there a long-term problem for the tech sector? As Nikunj rightly pointed out, people who have relied only on enterprise software are certainly facing a challenging long-term environment. Does that mean that there cannot be a cyclical recovery? Of course not. But our job is neither. Our job is to see what share prices are pricing in. And if share prices are attractive, then I can put these things aside and buy them. Sorry.
No. Sonali from my guest team had just said that, sir, please remind Mr. Desai that he's been ignoring my messages at least. You said you don't ignore any messages, so I'm just saying this is a comment coming from my guest team that Mr. Desai has been politely ignoring her messages. So.
I haven't ignored a single message of hers.
No, what I think we should do is, if you don't mind, we should take a very quick break right now and just come back for some final thoughts with Ridham Desai in just moments from now. Ridham, just stay on for 5 moments. We'll just take a very quick break and come back and wrap up this interaction with some final thoughts with Ridham as well.
Back with the market, right here in ET Now. Let's check in on the market. Haven't done that in a while. We're completely engrossed with our conversations with Ridham Desai. 81.72, so it's a no-go really. And typically, like yesterday, you're seeing better traction really built in for the small caps. What's holding out? Titan, that's spurred up a good 4.5% on the futures as we speak. Sun TV, Concor, HPCL, IOC. These are a cluster of stocks which are holding out. And within the Nifty, it's again BPCL, Yes Bank. There's no typical trend that you can map.
But the top loser is Infosys, and that's down
yes,
about 2
is.
percentage
2%
points.
down.
So that one is
So,
maybe the comments, maybe for a day. We don't know how long it will last. Apparently, of course, Ridham believes it won't last for too long. No, but the only thing is that, from that letter, and your point is right, just that the letter gave a feeling that Indian IT companies know that automation is upon them and they have to adapt, but employees are not being able to come to terms with it in a manner soon enough to the liking of the employers. I mean, that's the sense that probably the letter threw. But anyways, I mean, I take on board your point that the valuations are really attractive. One of the other points that your note makes was how good the year, or it was a year of a lot of initial public offerings, and a lot of those were successful. 2017 will have 2 large IPOs in the first half, arguably, and a lot of others coming in as well. You reckon that the market depth is now good enough and the fund flows are good enough on the domestic side as well for large offerings not to disturb the fund flows into the secondary markets any which ways?
Yeah, the market is actually hungry for quality IPOs. So let's bring them on.
Bring them on. Yeah. Any thoughts on the exchange IPOs that are going to come in?
No, it's good. It's good for the exchanges to list, and these are reliable business models with strong moats around them. You have to see the valuation.
As an investor, the first thing which we always watch out for is the size of opportunity, the scale of opportunity. There are a lot of mega trends which are in making. Because of GST, unorganized sector will become organized sector. Because of digitization, the way Indians would spend, the way we would consume would also change. Now, these are 2 big, powerful reboots, and they are once in a lifetime reboot. So, any thoughts on what could be the mega trends, mega themes for next couple of years?
That's a loaded question. I'm not prepared for such a question. I think the first trend that's happening in India is urbanization. Okay. It's happening very rapidly, and that brings to the fore new types of demands which we will underestimate, like demand for consumer durables, consumer discretionary. It actually does not matter the channel through which this is sold. The internet only facilitates faster adoption. So it's a channel. Unfortunately, investors can't participate in that sector because they're not listed. But I'm not, I wouldn't be bearish on India's brick and mortar retail either. I think we have a slightly different evolution that is likely in India. And you can see that there is a shift in thinking elsewhere as well in the world, which is brick and mortar is making a comeback.
Yes, so true.
And there is a bit of a levelization that's happening. So that could also be the case in India. But the demand, because of urbanization, will, I think, be one big trend that you should not miss. The second, as you pointed out, is the financialization of India's economy. I wouldn't narrow it to just digitization. I think there's a whole big trend that has been ongoing for the past 2 years, that households in India are more comfortable today saving in financial instruments and also borrowing. So the household balance sheet will actually grow quite rapidly, which is another source of opportunity, and that's also another big underlying trend that will continue for the next few years. So I think these are the two big trends that I see, and therefore you want to buy consumer, discretionary and financials as two core positions in India.
Do you think the demand will come back like almost like a recoiled spring, so to say? I mean, for the last 2 months and maybe 1 or 2 more months further, demand for discretionary has been compressed because of demonetization. Does it come back with a flurry?
Possible. There will be a few inventory adjustments that will happen. So it will appear that primary demand has come back quickly because inventory may have been affected by what's happened in the last 2 months.
Sure.
But the trends may vary from sector to sector. It won't be uniform. So there will be some sectors which I think, like consumer appliances, I think will come back very quickly. But maybe cars come back quite quickly.
Okay.
I'm not so sure about two-wheelers, so we'll see.
We'll see. Okay. And where are you anti-consensus, Ridham? That's my question to you. I mean, IT, you're not anti-consensus. You believe valuations are great. I think I've heard a few other people on the street saying this as well. Where are you anti-consensus on the industry? Either on the bearish side or on the bullish side?
So, what do you define consensus as?
Consensus
what the buy side is doing or what the sell side is doing?
No, you choose. All I'm trying to say is, okay, let's choose what your clients are saying. I mean, your clients are saying that this is a trend which will work and you don't think so.
So, my clients are bullish on India, so I'm with them. Most people are quite constructive on India. They're worried about the tax issues, impending tax issues, so they're hoping that those get sorted out. And maybe we'll get clarification in the next 30 or 40 days and maybe in the budget. But aside from that, they are, I think, quite constructive on India. I think there is a little bit of a lull in the appetite for bank stocks, which is where I may be a little different.
Okay.
Also, consumer discretionary, I think people think that prices will go lower before you buy them.
Okay.
So maybe I don't think that happens, but we'll see.
Let's chat about the fun stuff now. The top book recommendations for 2017, given the voracious reader that you are.
That's a hard one. But there's a book coming up on Jan 24th by one of the greatest investors of all time. So I would rate him as one of the top 3 investors of all time, which is a hard thing to do. So it's Ed Thorp, who retired in '89 and he's written his autobiography, which is coming to the market on 24th Jan. I can't wait for that. So the man who beat Wall Street and Vegas, something of that sort, the title. So it's how to beat Wall Street and Vegas. But it's from Ed Thorp, so you have to read it.
Interesting.
Wonderful. I look forward to that book. Appreciate your time and hope to see much more of you at least in 2017.
Yeah, definitely.
Thanks, Ridham.
Have a wonderful year.
Best wishes
Thank you.
for
Same
a
to you.
great
Thank you.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.